And so when we were putting this session together, we really wanted to focus on what we thought were the most important topics of interest to you. And whether you are looking to acquire an existing store or build one of your own, what's this laundry worth, becomes a very important question, right? And so whether it's on the valuation side, deciding the acquisition side, or what your newly built store might be worth when it comes time to sell, either way, it's of very much importance to you. So we thought about who's the single best person in the country to cover the topic, and we're happy that we got a yes from John Vassiliades. John has really played just about every role you can play in the industry as a distributor, broker, manufacturer's rep, and believe it or not, he used to have my job. And he's probably the best reason why I have the job today. John's been a mentor to me and actually worked for the association as president for 8 years. And before that was a volunteer chairman of our board. And in the course of his brokerage business, John has handled, almost 500 laundry transactions in the market.
More than that.
Probably more than that now. So has been through more than a couple valuations, not only the valuation, but also the due diligence part. I know a lot of you have questions about, it's one thing to say what it's worth, but how do you prove it? So with that, we've got John as our expert. He's got the next hour to walk you through it. So help me welcome John Vassiliades. John?
Thanks, Brian. It's a real pleasure to be here, and particularly seeing people from all over the country. I learn more in these sessions than you would probably learn from me, so I enjoy every opportunity to get in front of an audience like you. We're going to cover a topic that is very difficult. It's not precise. It's not scientific, but I think we can get you to the point where you might feel a little bit more comfortable when you're taking a look at stores and trying to evaluate what you're buying or what a potential store might be. As I say, there's no silver bullet for putting a price to a store. And it's not like buying a large corporation that has staff of accountants and financial advisors and everything like that. This is just a small business, but one that I feel is a great opportunity for people to want to jump into owning a business. I know my first business was a restaurant, and I did that when I was in college, and I almost killed myself, and in a year and a half, well, you turn around and sold it, fortunately, but only to learn that, I would never do that again because of the extra time involved, and I was working from early in the morning until 3, 4 o'clock at night in the morning. So I wanted to eventually get into a business that I felt was very comfortable, something that I could do for half a day or 20, 25 hours, 30 hours a week and still have some free time. So when I got to that point, after doing different things, I decided on a laundromat, and the first one I bought was an existing store. I kept that for 5 years, sold it, used the profits to build a 5,000 square foot store, kept that for a couple of years. I still kept that for more than a couple of years, but in a couple of years I was able to build another store and another store and another store. So then came the opportunity to sell. And I had a tremendous price from a party that wanted to buy them all, and I sold them. And so I'm still keeping the buildings, and I'm a landlord as well now, so I'm enjoying all aspects of that. But to get to the point, there's a couple of approaches to evaluating a store. And the gross income approach, I'm only mentioning here because if anybody tries to use this approach on you, I would run from them as quickly as possible. And that means you're going to take and consider only the gross income of a store and use that at a multiple like 1.5 times the gross income, and which doesn't really tell you anything about the net, and they could be losing money. So quickly, the valuation of gross income approach is really something we don't want to be with or use. Asset-based approach is something that you would probably use if you're just built a store, it's brand new, has no track record. The banks like to use this approach on new businesses, on even existing businesses. They want to know, well, what happens if it fails? How do I get my money back? And 9 times out of 10, their only avenue of getting any money back would be sell the equipment. You really can't sell the leasehold improvements. So this would be an asset-based approach. Well, that brings us to the income value approach. Yes. Leasehold improvements, let's say you're in a shopping center and you've talked the landlord into putting in the main sewer work for you, and he does that and maybe builds it into the price of the lease, or you're going to put another $200,000 or $300,000 into plumbing in the floor and heating and not necessarily heating, but electrical, ventilating, floor tiles, ceiling, special lights, whatever. You're not going to get that back if you have to move. You can't resell that to anybody. In fact, most of the leases, and I'm sure Van's going to get into that, most of the leases may require you to remove all that stuff when your lease is finished or when you move. So you have to be, that's what I'm referring to. Most people in our industry would agree with the income approach. And basically, in a nutshell, that means that tell me how much money the store is netting after all operational expenses. And that's your kind of net cash flow. That'll tell you how much money is left to pay your debt service, your interest, and how much is left in your pocket after that. So I think that through the years, this has proven to be the best approach. For an example, if a store sells for $100,000 and the net cash flow is $25,000, the store will return 25%. That's pretty easy, right? Going another step, $100,000 sale price divided by 25 equals a net cash flow of 4 times. So if somebody says that the store is netting $25,000 and you say, okay, I found out that in this particular area, stores that have sold in the past, comps, have sold for about 4 times their net cash flow, then you can feel pretty comfortable that you're in the market at a 4 times net cash flow, correct? I mean, it makes sense, right? Well, net cash flow is almost the same as, but I can't even say it, but it means earnings before interest, tax, and depreciation and amortization, for the purpose that will be the same as net cash flow we'll be talking about today. But what I really want to point out is that interest and taxes and depreciation and amortization are going to vary, right? If you're buying a store, that depreciation that seller has is not going to be necessarily the depreciation that you're going to have. And the same with interest and amortization and so on. So we want to set those aside for right now. Every time I do that, the accountants in the audience go, oh. But we'll just set that aside for a while so that we can come down to more of a common denominator, so that we can evaluate this store that's doing $500,000 and netting whatever against this store that's doing $100,000 and so on. When using the income value approach, we're reducing the values to the common denominator, and we're going to adjust other factors. This eliminates the unrelated factors such as interest, depreciation, amortization, and reduces it down to operating expenses. So what are operating expenses? Utilities, rent, right? Labor. What else? Insurance. What else? All these things that are on, if you've got a copy of this P&L statement, I'm sure you should have one on your table. Take a quick look at that just to scan it for right now. This is a pretty detailed sheet, and I've used similar sheets for evaluating businesses and trying to come up with an adjustment on their current P&L statement. So these are all, and this is pretty extensive, so these are all, a lot of these are all the operating expenses, and on the right-hand column, you can see at the top there, our figures, which means the seller's figures, and a new owner, that's the new owner column off to the right. That's where the adjustment will be made, and we'll get into this in a minute. But right now, just scan through there. There's repairs and maintenance and salaries and payroll and so on. All of those are operating expenses. Well, just because I'm using a 4 times net approach doesn't mean that that's what it's going to be in your particular area. And in some places like California, some people use a multiple of a monthly multiple instead of a yearly multiple. But in the Midwest area, this is what we've been doing, and I think in some other areas they use the same thing. How do we determine what a house sells for, or what a valuation of a house is? Anybody know? Price, but comps, right? Comparables. What one house has versus another house. So if you're in the same neighborhood and one house sells for $100,000, has 4 bedrooms, and another one sells for $300,000 and has 3 bedrooms, well, you have to make some adjustments and to come to a common denominator. And that's what appraisers do. That's their job. Their job is to find out what the comps are, what have houses sold for in the past, what's the makeup of that house, what's the neighborhood of that house, so that is that comp usable for what we're trying to do. And this is what we do too. And being a broker and selling a lot of stores in a particular area, we're able to determine at any one time what stores are kind of selling for, because we've sold them. So just as a quick example, of store A, net cash flow 25 sells for 100,000. B, 100,000 sells for 100,000 net cash flow sells for 400,000. And C, the net cash flow 75,000 sells for 300,000. What's the common thing there? Well, they all have a 24% return, right? 25% return. So that market then, if these are sold stores in a similar area, I'm able to determine that pretty much the market is 4 times net cash flow. However, there are other factors that are involved. This just takes it a step further, and not every store sells for a 25% return, so you're going to have some that are going to bring 33%, and others going to bring 20%. So in that case, you're going to have to average it out and see where the range is. Well, the range is between 3 and 5 times the net cash flow if you use that sample. Okay, well, not every store is the same as another store. In fact, Bob aptly named some stores as a stick of dynamite, and other stores good or possible, and other stores great. Well, what determines that would you think? Would you think that the age of the condition of the equipment would be a factor? And that's pretty hard to put a figure on, right? What else would you think would be a factor? A lease, yeah. That's going to be a factor. And why would that be a factor? Particularly in evaluating a store. If the lease is $1,000 a month, just for round numbers right now, and it's hard to find one for $1,000 a month, but let's say it's $1,000 a month, but next year it goes up to $2,000. Isn't that a factor? So if you buy it today, you're buying it under one pretense, and then you're another year down the road, then you're into something else. So is the value of the store really at $1,000 for rent, or is it okay, so those are the things that you, how about equipment-wise then? If you need some equipment, and we'll get into that in a minute, wouldn't that have a factor on it? Okay. Recent changes in demographics. What do you think would happen to make a store get better or more profitable in a shift in demographics? What do you think? What would happen? Pardon? They build an apartment building? Oh yeah, that's a possibility, definitely. Anything else? Yes? Younger families moving into the neighborhood. And that's a very good example. Younger families bring what? More kids. More kids bring what? More laundry. So these things happen. On the reverse side of that, you could have an exodus of a certain group of people from an area and have the reverse effect. So demographics does play an important part, even on an existing store. How about deferred maintenance? You know, if the guy or gal or whoever was operating that store, and by the way, I have a theory, and it's been proven out quite a bit, that the majority of the stores tend to fall apart because the owners fall asleep at the switch. They get so used to having that income coming in, they forget to advertise, they forget to replace their equipment, they forget to remodel, they forget to change the light bulbs, they forget to retrain the attendants, and they fall asleep at the switch. And all of a sudden when they wake up, they're saying, well, what happened to my weekly income? I don't have that anymore. Where is it? And 9 times out of 10, they're just not up to building that store back up again. But what is that? I consider that to be a beautiful opportunity for somebody to come in. Okay, so here's the equipment example, and it's a very simple example, but let's say there's $10,000 worth of equipment that needs to be replaced today. If you buy that store, you can't go any further because, you know, all the top loaders, for example, are broken, or 18-pounders. So if you divide this happens to be a top loader. I'm not sure you would be buying top loaders anymore, but 10K divided by 5-year life on a top loader is $2,000 a year. Then you would deduct that at least $2,000 off of the net cash flow and reevaluate. So for every dollar you take off, you lower the price by what? If it's a 4 times net. Pardon? 4,000, right? Okay. So those are some of the things that you have to do. If you're not dealing with somebody that knows what they're doing, please find somebody, because it's not easy to do and it's not easy to determine. So work with an expert. This is so important because different factors will change from neighborhood to neighborhood and from state to state. And I've seen this clear across the United States, where you might have a dedicated area in, let's say, Florida, that the city council decided, well, no more laundromats, okay? Or even worse, the Metropolitan Sanitary District says, no more laundromats, more likely the case. Or there's a hefty fee to get into the business, like some washer and sewer fees that may exceed $500 a washer. So these areas change a lot. So an existing store in an area where it's difficult to get any kind of new sewer, you're going to pay a premium for that if you want to buy an existing store, right? If there's only 10 stores that can be done and built in that area, those stores now command a very high price. So let's take the Chicagoland area, for example. There are stores that are selling on the north side. There's stores selling on the south side. There's stores selling out in the far western suburbs. All of those areas have their own characteristics. You might find a pocket in Chicago where you'll have an excessive amount of stores, maybe too many for that particular area. And so the value of those stores, even though the market might be 4 times net cash flow, you've got to do some tweaking on that to get to where that value is, or where that value should be. Here's a good factor. You know, we can, let me give you an example of when I bought my second house. It was on the market. It needed a lot of work. The broker told me, well, you'd be crazy to buy that house at full price, and this is what they're asking for. And I had visited that many, many times with my wife, and she had to go to Florida for a reason. And she called me up from Florida and she says, don't let that house get away from us. What does that mean? You know, what does that mean? Well, any valuation that came up based on market was out the window immediately. My evaluation was based on my wife's want to get that house. And as it turned out, I paid over market for it. And I kept it for 20 some odd years, 27 years. And it was the best house we ever had. And I sold it for over market price. So it's not exactly what, you know, it's not a science. If you think that that store is a good fit for you and you've done all your due diligence, which we're going to talk about here very shortly, then really what the market says and what you say are going to be 2 different things probably. But again, on the other hand, if the store is just not comfortable and you don't feel good about it, when you walk into the store, you go, you know, yeah, it's a good store, but I just don't, it's not quite there. Don't get it. Walk away from it, even though it might be below market price. Okay? Follow what I mean? Don't make it a love affair either, because if you fall in love with something and you kind of go half blind, right? Okay, you know, yeah, I understand that it needs a lot of work, and oh yeah, we got to replace some washer. I can do it, and you might get on there in a shoestring, and then it might be a great store, but you're in there for all the wrong reasons. So be very, very careful with that. Every store is different. Every person is different. Well, before we go on to the next section here, I want to ask, is there any questions or anybody has comment on that? Okay. Yeah.
Out there.
Well, here's the thing. If somebody that has had experience, whether they be a laundry broker, a distributor, or a good friend that owns 5 stores, those are the people I would be talking with. I wouldn't be talking with one that normally sells houses or commercial property, has never sold a business or never sold a laundromat or hasn't sold close to 1,000 laundromats or whatever. So I would get with somebody that knows the business and knows what to look for and let them help you be the guide on that.
What if you're dealing with
Why you want to buy a laundry?
That's a lease and not.
Oh, that's a lease then? Okay, so the question is, why do I want to buy a laundry that has a lease versus owning its own building, right? Or a possibility of owning its own building. And the answer to that is, there's two different businesses here. We're talking about the laundromat business, and then we're talking about a real estate business. And yeah, they're tied together. But if you got the wherewithal to buy both, then you might want to look at that. The opportunity for finding and buying building and a business are very, very few that are out there. And what happens is that most people, like myself, will keep the building and sell the business. And as long as there's a good rent there and you can still make money and get a good long-term lease, that Van's going to talk about in a little while, with all the things in the lease that'll make it comfortable for you to sign on, there's nothing wrong with that. There are a lot of franchises, for example, in other businesses that refuse to buy their own property because they want to concentrate their assets to buying business and cash flow. So I hope I answered that. No? Close. Any other questions? Pardon?
If I have the money.
If you have the money and you got the opportunity, why not? Absolutely. I'm not saying against it, no. Absolutely. Okay. Yes, you have a question? Yes. Okay, how does that differ when you're buying a business only versus buying a building and business as far as financing goes? Well, and I'll give you just some quick things here. Let's say it's an SBA finance, just to pick one out. SBA kind of likes the building aspect of it. They want to own everything, and they want to use that as collateral. So they'll even extend a good part of the, if not all, of the price of the business into 15 years amortization, maybe 25-year amortization. So you've got an advantage there, but normally you're going to have a situation where there's one company that'll probably finance the business and another company will give you a mortgage on the building, or you might find a bank that'll do both. And there's nothing wrong with that. The more collateral the bank has, the happier they're going to be, right? So, or if they got a good long-term lease, they're almost as comfortable. What we really want to determine when we go back to trying to evaluate the business is what are the real expenses? What are the real working expenses? And what's the real income, right? That's the big question. And I don't want you to feel disappointed, but I don't have the 100% answer to that. But I'll come close, all right? On this statement that I gave you, a P&L statement, and this is something that you might want to use as an example if you're fortunate enough to find a laundromat owner that selling his business that has a beautiful P&L statement like this that corresponds directly with their tax return, you're going to be a very lucky person. So let's assume that you did find somebody like that. And what you're going to do is basically what we've done here. We're going to put the figures that are given to us and what figures are going to apply to us. So the income figures, assuming they're correct, are all over on the right-hand side, correct? Even the cost of goods sold, that's pretty easy to determine, and we'll get into that. But things like automobile expense, there are a lot of people that write off a good part of their automobile with their business. There's nothing wrong with that. You're going to have a different situation. If you want to do it, fine. But that's not an operating expense unless you're using that vehicle to transport laundry back and forth. It's going to be a hard thing for anybody to believe that it's part of the business. So I would subtract that. I don't put that in the right-hand column, or the gasoline expense or the insurance to operate that vehicle. So business insurance certainly goes over there. Workman's comp goes over there, second page. Credit cards, not if they're going to be used for personal items, so I'll subtract that. How about laundry supplies? That's going to go over there. Licenses and permits, yes. Internet charges, okay, if they're for the store, no problem. Rent, certainly, right? Okay. Repairs and maintenance, yes. Now, if there are repairs and maintenance that are scheduled on here that are to take care of deferred maintenance from last year, and you're looking at it, and they're not ongoing repair and maintenance items, then you may want to separate that and only put on the operating expenses or main repairs. Salaries, what I usually do in the salaries is, who knows what kind of arrangements have been made with the people that are working in the store right now with the owner and whatever. They could be friends of the owner, relatives, or they could be being paid in excess of the going rate. So I usually plug in my own figure in there. And based on the amount of hours in the store and how many attendants have to be in that store at any one time, that's easy to do. You plug it in, you add another 15% for everything else, and you should come very close, because you're not going to operate at the same, exactly the same as the current owner. Well, scavenger and all these things apply, operating expenses, all the utilities apply, and the income from other items other than the wash and dry or drop off laundry, like the ice cream machine, for example, massage chair, and music box, toys, games, whatever. So all of those things have to be figured in. The only reason I hesitate here is that the management vehicle should have not been put over there, and that's just below the games. So, but anyway, what's this going to bring? Now remember, this is only from January through October. So what we're going to do is find out what the net cash flow is after real operating expenses, before depreciation, before interest, before amortization, and so on. So we want to know what the cash flow is so we can determine how much money we can pay the bank and how much money we'll have left over. Yes? Specifically, this particular deal was that he had 5 stores, and he had a manager operating the 5 stores, which would not apply here. So that should have been taken out, and that's an easy no-brainer. Wouldn't apply for you as you're buying it. Yeah, that's an expense that you're not going to have because you're going to be the manager. Yeah. Okay. Yes. Well, it's just because I picked that one out instead of the 12-month one, and I was already halfway here. So. But I would definitely pick a full year. In fact, I would try to get 3 years, the last 3 years of operations. Why do I want that? What's the main reason I want that? Trends, right? Is the business going up? Is it going steady? Is it going down? And if it's going down, are there things, what can I do to build that back up? So that's why I want to see that. But the real critical thing is the last year for most people. All right, then you take that, and once you adjust for the year, for 12 months, then you come up with a net cash flow. And then if the net cash flow is $126,000 and the going rate is 4 times, then that would be your price or a starting point for determining what the value of that store would be, because we still haven't decided what the age of the equipment is, what condition the lease is in, and so forth. So this is just a starting point. This is just a starting point. You have to go to the next step. Next step would be a lease. Van will cover that. And it's safe to say that if it's a good long-term lease with relatively small increases or reasonable market increases, then you should be in pretty good shape. You do want a long-term lease. Why? For obvious reasons, you can't move these equipment Bob mentioned that as well. All right, yes. Well, you can try that, but it's probably not going to work. I mean, but in actuality, his expenses that he's doing there, he might be spending money that is not really operational. So when you buy that store, you're only going to be concerned with the operational expenses that are going to go to you.
You gotta get the right call on why you take that step.
Yeah. Well, you know, there are many different ways of evaluating this. Well, once you get to a point where you're comfortable with it, let's say I did evaluate it this way, and you know what? I know that I can make good money, a good return based on that multiple, and these are my expenses that are going to be that way. I'm going to try and get the lowest price possible. But I know what the reality is. Okay, that's the point I want to make. Any other questions? Yes.
So you're saying this is top?
Well, the value of the business is tied in with the lease,
Right.
because you're paying so much a month for that rent, right?
Correct.
Now,
Back that out. No, we didn't.
no, you didn't. I was going to say it. No, it's in there. And what you might want to do mentally is adjust for whatever increases are coming up immediately. Yes. Let's say for the next 5 years, nothing's going to happen with that lease. No increases are going to happen on that lease. So for the next 5 years, you can be well assured that if you operate the business as good, if not better, than the current ownership, then you're going to probably get that kind of cash flow, right? Well, you might want to talk to some of the distributors about that, but typically, for the first 5 years, you're going to, you know, some if not all of the parts warranty is covered, and even in some cases, for the first couple of years, some distributors will cover part of it. But I've seen anywhere around 2 to 3% after that, and the older you get, of course, the more it's going to be, and you can get a pretty good idea from what they're spending last year and what you might need to do for next year. The sell price, the asking price for this, just for example, in a 4 times market, exactly, and that was the list price for it, $500,000. Is it going to sell for $500,000? Probably not, but that's a good starting point. You're going to try and get it for as low as possible, and the seller's trying to get as high as possible. So it's a dance you do, and at the end of when the music stops, if you feel comfortable and he feels comfortable or she feels comfortable, you've got a deal. And that could be a little higher than the market, could be a lot lower than the market, could be anything. But whatever it is, that becomes one part of that market in that area. Okay, now the hardest part. How in the heck do you find out what's the truth? Right? I mean, it's tough. I've been doing it for a long time. I don't want to even tell you the amount of years, but it's been a long time. And like I said, I've owned 5 stores, so it's hard to determine. In particular, if you're in the outside looking in, and unfortunately, not everybody has good P&Ls like this. But let me make a point. Let's say that after you learn what I'm going to be talking about, let's say that you find somebody that doesn't have a good P&L like this, but that you do your due diligence and you reconstruct and you find out that the store is still worth some money, even though he may not be reporting everything, may be doing things that he shouldn't be doing to good accounting practices or whatever. Does that mean we walk away from a deal? If we fully understand it and have a comfort feeling that he's really doing this amount of money and we're willing to pay for that at that amount, should we walk away from it just because he doesn't have good records? Not necessarily, right? If we can prove it and feel good about it, let's do it. Because if you don't, you're going to walk away from a lot of stores. On the other hand, you better know what you're doing because you could buy the wrong store. So it's a delicate balance, and one that hopefully you'll learn a little bit more about today with the other sessions as well. Check for leases and the rental and all the things that Van's going to talk about, so I'm not going to go into that. Check the utility bills. Okay, if it's in a area where you know, just for example, I don't want you to use this for a fact, but let's just say that in an area where comparable stores are paying 25% for their utility bills, and your store that you're looking at is priced similar to that, because that's important, right? You have a higher price, then your utility bill is going to be a lower percentage. If you have a lower price, then your utility bill is going to have a higher percentage. If you have free dry, your utility bill is going to be even a higher percentage. You with me? Okay? So you got to consider apples for apples. So make sure that you can use a rule of thumb, 25% in a certain area. If the store has newer equipment, less, maybe 20%. And if it has real old equipment and a free dry, you might be able to be at 33% as a utility factor. So it's very difficult, but as a rule of thumb, I'll scan it, and if I'm within 25%, then I'll keep looking, okay, or close to that. So that's one of the factors. You want to see the actual utility bills. That's a good indicator, particularly the water, right?
So can you just go and get the utility bill?
It used to be that way. It's a little bit more difficult now, but you can still do it. You can still do it. You might need the permission of the seller, and if he doesn't give you his permission, then you'll wonder why. So that would be the first person I'd go to. Then I mentioned plug in your own labor costs, right? Because your labor costs are going to be different. Unless you plan on hiring that entire staff, at least on a temporary basis until you get your feet on the ground, and then you can make some adjustments. But if he's been there or she's been there for a long period of time, being an owner of that store, chances are the wages are going to be higher than market. Chances are, maybe not. A good way to check on what is being sold in the store, and a lot of people have added these services, big box sales, selling big boxes of soap, gallons of Clorox, and so on, bleach, whatever. And you can pretty well determine by figuring out what the percentage is. So they've priced it at a big box of soap at $10, and your price is $5. You know that they're making a 50% margin, right? Right? So look at the actual bills when they tell you that they're doing X amount of dollars in vending sales. You can check that out by looking at the actual invoices. What else can you check? About stores that have drop-off laundry service, right? And a lot of stores are doing that today. Why? Because it's a natural service. If you don't do it, the dry cleaner is going to do it, and you might as well get that business. And there's a lot more profit in that, actually, if you do it right, than there is in wash and dry, regular wash and dry. So if they're being operated correctly, they should have invoices, or they should have a POS system, point of sale system, that works off a barcode or some similar device that'll ring up a ticket after you weigh it and say there's 10 pounds here, 10 pounds is $10 if it's $1 a pound, and it automatically clicks and makes a receipt, two-part receipt. Customer gets one, you get the other. If there are no receipts, then it doesn't mean that you walk away. It just means that it's going to be a lot harder to determine what they're actually doing in drop-off laundry. Yes. Well, in the case I'm saying, I'm assuming that they're being very cooperative. I'm sorry. The question is, if they're not being cooperative and give you all the information that you need, then there's one of two things that happens. One, they don't feel comfortable enough that you are a positive buyer to release a lot of information. So it might come down to a point where you're going to have to give them a letter of intent based on your due diligence, and if you're not comfortable 100%, you walk away. But at least you got some money up, at least you showed an interest and going through a lot of due diligence, which needs to happen. So if you got somebody that'll do that, fine. If they say, well, you know what, even after you offer them a money down and offer them, a letter of intent with a price that would be acceptable, and they say, no, I'm not going to give you anything, then I'd be very, very skeptical. Probably walk away from the deal. Probably walk away from the deal, yes. I've walked away from more deals than I've done. Any other questions on that? Okay, how about repairs? A lot of these expenses that I've got in here are really something that you can easily determine. And usually all the expenses wind up on the tax return anyway, and they're not going to, usually not inflate the expenses. So you can track just about everything, but maybe the repairs, you can't as well. So how do you determine that? Well, good way to do it would be to see what he's showing, ask to find out who the repairman is, what is the repairman charging? Is he on a contract? Is he on a weekly basis, a monthly basis, or on-call basis? And what typically would the monthly bill be? There is no way to find out exactly, because you can go for 5 months and have very low repair bills, and all of a sudden you may have a bearing job that needs to be done on a large washer, $800, bang, right off the bat. That kind of throws your projection all the way off, right? So try to determine, at least over the last year or maybe 2 years, what that has been, and using some expertise from people that you're working with, find out the age of the equipment and approximately what the good figure would be for repair and maintenance. Another factor that you need to look at would be the HVA system, which is the heating and air conditioning system. Landlords handle this a different way. If you're renting, some landlords will put the unit on the roof and require you to maintain it with a professional company. And then if it ever needs repair or service, it's your expense. In some cases, the landlord will require that you also replace it. So you got to read your lease very carefully on that. And the water heating unit that's supplying your store, that's another area where you need to take a closer look and see what you have there, what the age is. If it happens to be leaking water while you're there, then that's really suspect, right? Just little things like that. Or if there's a lot of complaints that there's not enough hot water on a Saturday or Sunday, that might be another red flag. Well, as part of your due diligence, which we're going to get into right now, you've got to spend some time. If you're going to invest some money in a business, you don't take anybody's word for it. You spend some time in that store. And the best time to do it is over the weekend. And really the best way to do it is to take your clothes in there and do it. Do them. I had one company that, one partnership that I built 11 stores for. And the one gentleman was tremendous at doing his due diligence. And he had the same bundle of clothes, mostly shirts, and he would take them in and he'd wash them every day of the week, different times. And I mean, that's to excess, but he found out who was the good operator, who was the good attendant, what was lacking. Maybe there weren't enough folding tables, that Bob said. Maybe there were not enough parking spaces. How are you going to find all that if you don't go there? Spend the time. Not only that, but I'm suggesting something else. I'm suggesting that you go visit every coin laundry in your marketing area, whether it's building a new store or not, or buying an existing store. You go do the same thing with every single store. How are you going to find out what your competition is if you never go into the store, never do the laundry, don't know what their tenant is, don't know what their equipment mix is, don't know what their pricing is? All of these things that we have to have knowledge of to make good business decisions when we buy that store. Wouldn't you agree? So that's where the due diligence really comes in as far as competition, as far as finding out what this store really does on the weekend or on a Wednesday when there are probably not too many people there, but maybe on a weekend where people are waiting for a dryer. And what does that tell you? Maybe you need more dryers in that store. Maybe you need to change from single to the dual dryer, the stack dryer. Okay? So all of these things will come to light a little bit more when you know what you're looking for in a store. Well, go to the tax return first, or P&L statement, or both. Check the utility bills, compare similar stores in the area. Be careful not to rely on a water analysis. Do you know what I'm talking about when I talk about water analysis? Water analysis was really, I think, contrived by the IRS, and they try to use a formula for determining, well, if a washing machine or a laundry uses X amount of dollars or X amount of gallons of water in a store, then, you know, we can go backwards on that and figure out, based on the price, based on a lot of other things, what that store is actually doing versus what it's reporting. Well, the IRS tried that, and even as smart as they are, I hate to give them that credit, but they were not able to prove that in court over the long period of time, and they abandoned that. I'm sure somebody's trying to use that somewhere, but I've used that same formula to see how close I can come. The best I've been able to do is 10 to 15%, and that's with knowing exactly what I know. So for somebody that doesn't know what they're doing, then you try to use a water analysis to determine the volume of the store. Be careful. Be very careful. Okay. What's the best way now? What's the best way? What do you think the best way is to determine what the store is actually doing? Pardon? How many turns? I mean, everybody talks about turns, but mostly in new stores. I mean, that means a lot, okay? But, you know, half the store owners out there don't even know what their turns are. You'll have to determine that. And the only way you're going to determine that is to what?
Spend some time at the store.
Yeah, doing.
Due diligence.
And what's that due diligence? How about counting the money with them? That's a good way to do it, right? I just sold a store where the due diligence took 4 weeks. And what did those people do? They watched the TV cameras remotely. The buyers watched them because the seller was very comfortable with that. He knew exactly what he was doing and everything. And so he let them watch the store over the camera so that nobody could stuff the boxes. And then every Friday they'd go into the store, collect the store, weigh the coins, blah, blah, blah. And it turned out that they were extremely comfortable, more comfortable than I thought they would be. So there must have been something else there that I didn't see. But they were very comfortable. But they did it to their satisfaction because the offer they made was subject to their satisfaction. And that's the way it should be, right? If you're not satisfied with what you see or hear, don't do it, because you'll be kicking yourself in the butt for a long, long time. And it may cost you all your savings. But if you do it, and you do it the right way, you'll at least know what the starting point is. Does that guarantee you success? Absolutely not. Absolutely not. I mean, you could be a worse operator than the current operator, right? Or in many cases better, because I've seen lately a lot better group of buyers, more sophisticated, more educated, and the reason is you come to these seminars and you're able to get the information that nobody else has, probably more information than the seller has. So due diligence means not only looking at the tax returns, not only looking at the bills, not only looking at the water consumption, not only looking at the deferred maintenance, not only looking at the age of the equipment, not only looking at the parking that Bob mentioned, is it adequate? The folding tables, are they adequate? All these things, if they're not adequate, then you figure them in. I'd love to find a store that's deficient in for example, folding tables or large machines or dryers, and if there's a way I can fix that, then I know that I'm going to make more money than what's even shown there. Your whole idea is that you want a starting point because you want to lower your risk down to a minimum. So if you have a starting point that this store is doing $100,000 net or $30,000 net or whatever it's doing net, you know what that starting point is, then you can build on it from there. And coming in with your enthusiasm and your information that you glean from these seminars and everything else, and your distributors and whatever, you'll be able to build that business a lot better. I'm convinced of that. Is there an advantage for small neighborhood stores versus the mega store? I still think there is. I'd be cautious about unattended stores. They work well in some rural areas or some very special places, but most people are not as comfortable walking into an unattended store, at least in this area. Now, further east you go in some other areas, that doesn't apply, but I know you're from this area, so I'm just saying this particular area. Most people, most stores that are successful are attended either part-time or full-time. And just because it's small doesn't mean it's not making good money. The size of the store, whether it's 1,000 square feet or 5,000 square feet, doesn't gauge how much money it can make. It's the capacity that it has and how much of that capacity is used and what the pricing is. Because if you get a really busy small store, that could do more and make more than a 5,000 square foot store that's doing a lot less volume. And it costs a lot less. Turns? Oh, I'm sorry. Okay. Yeah. The question was, what do we refer as turns? Well, turns are the amount of times a washer turns over, how many times it's used during that day. If that washer is used per day 4 times, then it's a 4 times. Okay, good question. Yes?
Is there a rule of
That's a good question. The question is there a rule of thumb for the distance between competitive stores? Well, I got to tell you that at one time in my life I would have thought that there would be something like that, but I've been in neighborhoods where there is a store right across from another store, and you can actually see what's going on in the other store. In fact, there are a lot of stores like that in California that I visited, and the guy's got his binoculars on to see what his competitor's doing. If they're both doing good business, what's the difference? I love those stores because if I can go into that store and do better than the other person, then I know I can steal some of his business. We're really not going to create a lot of business, new business, unless it's a new store in a new area. It'll create some because you might pull out some people out of their home to do the blankets and the pillowcases and whatever and the sleeping bags that you might not have had before. But essentially, you're going to be dividing the pie, okay? The demographics that was talked about. There's a certain amount of demographics in that area, and you're going to divide that between all the competitors in that marketing area. And the guy or gal that does the best in marketing, that does the best in training, that provides the best in equipment, that does everything the best, including the lighting and everything, is going to win more business, pull away more business, steal more business, any way you can. This is a competitive market. You can't be a nice guy, right? I mean, you've got a big investment. Probably all the money that that you've got put together you're going to throw into a business. So you want to make sure you're going to be able to do all the things that you can do to be a success. There are still stores out there because there are so many people that fell asleep at the wheel. And yeah, some of them, about the only thing you could do is a stick of dynamite. But it's our job here to go pick out that 1, 2, or 3% that's really could be very good for us. And if you do it the right way, using the right people, you should be able to get that done. Yes?
How hard is
Well, it all depends on the space that you have. The worst thing that you do is, and in some stores in Chicago I know where the distributor, one distributor, and he's not even here, so don't worry about it. But we're so anxious of selling equipment that they filled up the store and the aisles were only 2 feet. So, you know, you don't do that. But if you've got an adequate space in front after putting that machine in, and you can easily measure it, contact your distributor to see if it'll fit there. Then there's a problem about the load of the floor, because some of these larger equipments require more concrete on their base. And so logistically, there's no reason why you can't, just a matter of expense. And some require a bigger drain valve than you might have. So some of that plumbing has to be changed. But in almost all cases I know it's not impossible to do, as long as you got the space to do it.
Okay, we'll make this the last question, please. Yep.
No. The only the question is who really should be verifying this, yourself or somebody else? And my point is that you have to be the first one. That's your money, right? You got to be the first one. Now, if you haven't got the wherewithal or the confidence to do it yourself, then hire somebody else to help you with it. Somebody that's not going to be financially involved, or somebody that's going to give you an unbiased opinion. Well, only if they know laundromats. Okay? Like a broker, like a distributor, like several auditors that I know of in the Chicagoland area that do have a lot of stores that know what to look for. Yeah, you can do that. But the due diligence has to start with you. We can talk again in the back. Sorry. Okay.
Thank you, John. Terrific job.